Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into three simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. Hey, happy Monday to everybody. It is straight up 12 o'clock Monday, March 23rd. Glad to have you here joining me today. Patterns and profits. That's what we're here to discuss. Look at all this green on the screen back here behind me. It just, what a difference a tweet makes, huh? What a difference tweet makes. I mean, coming into the morning before the markets were even open, pre-markets were looking and then all of a sudden, one simple sentence changed everything. But we're going to talk about that. You know what? Welcome to spring. All of you that are here, welcome to spring. Spring is here. I want to talk about spring breakout and stocks that are in spring breakout that we're going to be looking at here at the top of the program. I'm also going to set aside some time for those of you here. Give me your favorite stock, and I will run it through the money calendar. And let's see what the money calendar has to say about it. So we'll do that too. And then finally, this is something I haven't done in a while. And I thought what I would do is discuss on option strategy. And this is one of the very first option strategies that I learned right out of it's a call, it's a put. Why not combine them both? We'll talk about creating a straddle, and we'll also start with some ideas of what you could do as far as reasoning for putting a straddle on. All right, that is the plan. Questions, comments for those of you live with me, you can put them right there in the comment section, and we'll be bringing up those stocks. We'll be bringing up Q&A and much, much more here during our time together. So let's go ahead and get cranking. So when I look at the markets, and this is just shortly after we opened, we saw, there isn't just green on the screen. Yeah, you see green all behind me. All right, these are popular stocks that you see behind me. But I want you to take a look at, what turned red. Okay, so what ended up happening this morning? Let's look at the headlines. The headlines all basically said this. All right, so first, the Asia markets tumbled. All right, this is early in the morning as Middle East conflict spirals with no sign of abating. Then, all of a sudden, Trump makes a few comments, basically saying that the war is de-escalating, and he's announcing a 5-day hold on any strikes when, just a day or two ago, he talked about taking out their energy grids, taking off the electricity grid. And so, coming into last night and coming into the day, two completely different versions from what's coming out of the White House. Obviously, what he said this morning, 10-year Treasury drops, European stocks stage a rebound, then the market jumps 900 points in the open after, U.S. and Iran have held productive talks. Right, continued live updates are going on. Gold and silver pair their losses as Trump postpones the strikes. Dollar gains. All right, this is an interesting one. The U.S. dollar has been moving kind of lock and step with the stock market, which usually isn't the case. Usually a dollar goes up. That means we get strength in the dollar against what? Against assets. Not recently. And then, of course, oil tumbles after Trump puts hold on U.S. strikes. against Iran energy infrastructure for 5 days. All right, let's back up a second here and let's take a look at again what I saw coming in. All right, this has been all over the board, folks. I mean, just 15 minutes before we went live, Dow was up over 1,000 points. I look now, it's up 700. But in any event, we're up nearly 2 percentage points here on the day. All right, S&P 500, again, it's having nearly a 2 percentage point upside. The NASDAQ was above 2% before we went live. The Russell was close to 3%. Then you look at the next grouping, oil, Brent oil, nat gas, RBOB, all down. And I mean down quite a bit. This was eventually going to happen. Okay. Eventually we were going to see a squeeze, a short squeeze on the stock market and a long squeeze on commodities like oil. All right. So we say oil down nearly 10%, both between Brent and regular crude. And then you've got nat gas down almost 5%. RBOB, that's blended gasoline that you and I get at the pumps, down over 8.5%. Gold, was down considerably more. It's come back a bit. Gold and silver really paired their losses. You've got copper up a little bit, and platinum down too. But then look at the bottom, that entire bottom piece you see here, cryptocurrency. Cryptocurrency is up about 5%, right? Coming into the lunch hour. That's what we're seeing. And again, it's all because of this knee-jerk reaction news that we're getting. The problem with knee-jerk reaction news, and you should all know this by now, is that unless for some reason you've got some sort of feed, you got some sort of inside track to what's going to be said coming out of the White House, right? Or maybe you've been playing the other side of the coin. Obviously, hindsight 2020 said get long on Friday, right? But that was hindsight 2020, and most people weren't listening to hindsight. Most people were coming into the weekend saying, "Oh boy, this we just broke some technical lows." So the market's going to head lower, and it really looked like it was going to do that. But then this knee-jerk reaction pulled some shorts. It pulled some shorts. Some people went short on Friday. They went long this morning, and they took their losses. They took some huge losses. So, when you look at this, I say this, patterns. What we do here is patterns. We don't do day-to-day patterns. For those of you that just stumbled upon us, welcome. Glad to have you here. We're not day traders. We're not meme traders, right? I don't trade the most popular thing being talked about on social media. In fact, I think the last time I looked at Facebook was in 2017. I'm running a good 9 years since I posted anything. I haven't had a LinkedIn account. I haven't had my X account is gone. Right. So, yeah, I'm not looking at social media to determine what my next buy is going to be. You should not either. So what do I look at? All right. Well, I look at repeatable things that repeat themselves. All right. Patterns that repeat themselves. And the patterns we like to look for are give or take about 30 days in the market. But I've been leaning to the 30 to 90 day pattern. Tom, why are you going out 90 days? Because when volatility climbs, you got to give yourself more time. Okay. Here's a brand new rhyme I'm going to give you that I just thought of. When volatility is on the climb, add more time. Okay. Because when volatility rises, the markets do a lot of this. And all of a sudden, a lot of things like trend go out the door, okay? But when you're using seasonality gives us the start date. Seasonality gives us the end date. And all I got to do is just push for the end dates to be longer. And that's what I want to do. Coming into the day, and this is no strange, you cannot be a stranger to this. I've been talking about this for 2 weeks now, at least 2 weeks, that the end of the month was going to be good news for tech stocks. I said tech stocks were overdone, and that if we were going to see a rally. I believed it was going to start with tech. And so did today become the turnaround day, or are we going to go through, or is this just a setup? Is this just a bull trap? Time is going to tell. But what we're seeing more and more is we're seeing, as we get into the end of March, as we get into April, we're going to see more and more green on the screen. And some of that has to do with what happened last year. Okay. Remember what happened last year? The markets fell hard in March, and they bottomed somewhere between, depending on when you look at it, between April 4th and April 7th or 8th. And then we started the long climb up that got us to new all-time highs last year. So are we going to repeat that pattern? Again, time will tell, but it's becoming more and more probable that we've been severely oversold, that again, seasonal patterns may come late, but we're starting to see this buildup of more and more bullish information, not just in single stocks, but in the overall markets. Let me share something with you. Take a look at this. So I blurred out, I get a bead on all stocks, start days, end days, which ones have really just the best looking setups. And the 3 ETFs that I want to share with you this morning. Okay. Now, are they the best? I didn't rank them by which ones were the absolute best, but I ranked them by more popularity. And these are having patterns. They've got patterns going on in them right now. Let's talk about each. First of all, I got QQQs up there at the top. So the Qs coming into today, they have about a 55-day pattern. In fact, all of these, the Qs, the spiders, and XLK have about have 55-day patterns. We'll talk about the differences between these three in just a moment. All of these going out to the beginning of June over the last 10 years have averaged anywhere from the low 6s to the high 7s in percentage moves over those next 55 trading days. That's fantastic. I mean, we're talking about the Qs 7.3%, SPY 6.3%, XLK 7.9%. Okay, in just between now and the beginning of June. So here's your spring breakout. Here's the spring breakout. It starts, I like to start looking at that 40,000 foot view. And the 40,000 foot view for me are the overall markets, the stock market, the bond market. All right. What else? Commodities, cryptocurrencies. But when I look at the stock market, I'm looking at SPY. I'm looking at DIA. I'm looking at QQQ. In this case, QQQ and SPY were near the top of the ETFs. All right. So let's take a look at each. Let's talk about differences. Well, for those of you that don't know the differences, the QQQ is one of the most popular ETFs, exchange traded funds. It tracks the NASDAQ 100, right? These are non-financial companies. If you want to know what makes the Qs, think about non-financial companies. That's what separates the Qs from the SPY. The SPY has financial companies in it. All right, it's more of blue chips, of broad blue chips. That's the S&P 500 ETF. And XLK, well, XLK is a technology select fund ETF. And so that has a focus. It's a technology sector with a focus on large U.S. tech companies. So that's the differences between the Qs, the spiders, and XLK. Let's take a look at each. Here's the Qs. So the Qs have had a lot of sideways action that really started late last year. We ran up and hit all-time highs back at the beginning of November. Let me put my mouse on it. Then again, at the end of January, we hit these all-time highs up here just prior to 640. We've also hit some multi-month lows. Now, there were multi-month lows back in October that were around this area 580, but we hit the 580 area back in December, and we did it again on Friday. And Friday, we closed near these lows, right? So green candle means we closed higher than we opened. Red candle means we closed lower than we opened. But look what happened between Friday afternoon and Monday. We had the gap and jumped right back up above the opening high on Friday. That's considered bullish. But the reason I have all this green on the screen right now is because seasonally, remember, between now and June 9th, we've got a seasonal push for QQQ. Now, let's do a little bit of work here, okay? If I believe that the Qs are going to move, let's just say 7%. Let's just say the Qs are going to go up 7% between now and June 9th. What I'm going to do is I'm going to take my $1,200 calculator here, and I'm going to plug in 590. You know, that's just a recent price of where we are right now. I'm just ballparking it. 590. Heck, let's call it 600 because it's maybe where it's at now. 600 times 0.07. In fact, if you do 600 times 1.07, that gives you the target. 642 is what my $1,200 calculator tells me. Okay, so that's somewhere right above, guess where? Above the all-time highs. If we get up to these all-time highs and we push through that, there's going to be a short squeeze. There are technical traders that have stops placed right above these all-time highs. Right? So if we drift up this way, we could take those out. All right, so that's one way of doing this. Let's look at the SPY. So if I look at the SPY, I see the SPY and wow, I mean, it was rough. You have these multi-month lows down here near 650, and then we close way below 650 on Friday, and all of a sudden, boom, we're hitting 660. You got all-time highs up here close to 700. Again, take the $1,200 calculator. Can you believe? And I'm talking to Gen X here right now. Who in their right mind would have thought, I'm going to buy a $1,200 calculator when I get older? Nobody. But we did. 660 times 660 times 1.06. All right, somewhere around 6 something. That puts us at 699 or 700. That would be all-time highs. Okay, between now and June 9th. Again, the calendar is what we're using. We're using 10 years of data. Back 10 years we went to find this information, to know that 9 of the last 10 years, the S&P, along with the QQQ, has gone up between now and the beginning of June. It's happened 9 of the last 10 years. Now, I'm not guaranteeing it's going to happen again. I come to the table here with no guarantees. But again, I'm a pattern trader. When I see something happening over and over and over again, that's the side I'm going to lean on. Okay? That's the Qs. How about XLK? XLK was that was the near 8% move that we were looking for. Now, I added something else on here that I should have added on the other two for you option traders. You see that red line down here? That's implied volatility. Do you see the lows at implied volatility? And then where it is right now, the highs, right? That's true for the Qs. That's true for the SPY, and it's true for XLK. Options premium is high. That might tell you something if you're an option trader. It might give you a clue of what to do if you want to go bullish on any of these haystacks, okay? We talk about this a lot. My partner Jay talks about this a lot. He says, why trade the needle when you can trade the haystack? I like the haystack because the haystack is comprised of a lot of needles all in one. And that's what the SPY is. That's what the Qs are. That's what XLK is. It is a group of stocks that fight amongst themselves, but the overall crowd in those stocks will move it in one direction or another. It has diversification. But even diversification can have expensive options from time to time. So if you're an option trader, keep that in mind. All right. So moving forward, we know that all of these have seasonal patterns with them. They all have that 9 out of 10. Again, if I were to take a look at XLK, what am I going to do? You know what I'm going to do? I'm going to use the $1,200 calculator again. And I'm going to say to myself, all right, 140, roughly current price, times 1.08 equals 151, which, guess what, isn't even the all-time high. It's just below that. So what does seasonality do for me? It allows me to have a target time. It allows me to have a target price, okay? It allows me to have all these things. So when I go to look at target time and target price, I know when I can get in. I know roughly when the pattern's going to end. And if I'm an option trader, I have the ability to look at implied volatility to tell me, do I buy cheap options or do I have to spread by risk? So in the end, to summarize this, we talked about that big upside coming for the last couple of weeks. It looks like it may be starting. Trading the haystack is the best way to ease into a seasonal change in the markets. And that's what we're looking for, folks, that seasonal change. And then finally, implied volatility. Well, it's high right now, which could help determine the right option strategy. Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into 3 simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. All right, this is the part where I want to take your stocks and I'm going to run them through. I haven't done this year, all right? I want to take your stocks. I want to run them through my money calendar, and let's just see if there's anything going on in terms of those patterns. And if you have a favorite stock that you want to look at, then just punch it in. If you're live here with me, go ahead and punch it in. I'm going to try to get to as many as I can here during these next few minutes. So to do that, I need to get over and I need to look at the money calendar. All right. So the money calendar software that we have built into Hub. And this is something that we put out there to our members. And if you're interested in this, then give us a quick shout. Members only. I'm thinking about that jacket. Member services at Gulfport Analytics.com. Member services at Gulfportanalytics.com. And I threw that right there for everybody to grab if you have any questions or want to be part of using my money calendar software. We can tell you how you can do that. So what I'm going to do is I'm actually going to take the last 10 years and I'm going to look at any patterns that are 80% or greater. Right? I like to look at 90, but we'll go from there. And so in order to do that and look at single stocks, I'm going to be able to go and take this information. And right now, Becker, he was first up. He said, hey, can you take a look at Palantir and Tesla? So let's go ahead and do that now. In order to make this, to be part of to show up on my software, we have to have years and years of data on this. So I may not have every single stock, but I look at the most popular ones. All right. PLTR is one of those. So Palantir, and let me blow up the screen so everybody can see this. I don't have anything for Palantir for the month of March. I could go forward into April and see if there's anything in April. Not a thing, not an 80% pattern. And you know why it might be? Because I have to ask myself that question. Has Palantir been a stock or has it been trading for the last 10 years? Okay. Maybe I look at the last 5. All right. Ooh, last 5 definitely shows something. It shows a lot of red on Palantir. So what I can do is I can look at Palantir stock and I can say, well, you know what? It looks like over the last 5 years, 3 of those last 5 years, it's gone down in price. In fact, the last 3 years in a row, see that green on the screen? That means the stock has moved lower between now and really going out to about the next couple weeks. We see that move happening between 2023 and 2025. Last year went down 17% during that time frame. So if we're looking for a seasonal bottom, this isn't a lot of data to work with, but it's a start. Just gives you an idea. I like to work with at least 10 years worth of data. And you know what I'm going to do? I want to throw this all the way out where I'm looking at the longer term stuff. I don't want to look at the stuff that's short term. I want to look at really 20 calendar days or 20 trading days all the way out to 60 trading days is what we'll be looking for when we look at stocks moving forward. Let's go ahead and look at Tesla while we're at it. So down here, I'm going to change to TSLA, and we can look at single stocks that way. Oh, look at Tesla. So Tesla has an area of bullishness in it. Let's take a look at what's coming up on Wednesday. And this shows a trade that has an 80%, all right, 80% probability going back 10 years, meaning that, here's the thing with Tesla. It was a real winner back before COVID. But then after COVID, the patterns have gotten less and less because Tesla's gotten less volatile, at least during this time. 2022, it went down. Last 3 years, it has gone up. It has gone up a bit, but you can see, here 35%, 6.79, 3.94, and that's between now and around the middle of June. All right. So that is Tesla. All right. Let me back it up again. Let's get to the calendar and let's see who else has something out here that they want to look at. I don't think AIRA is in my database. It is not. I apologize for that, Magic. It's not there just because we just don't have the data for it. Okay, here's a couple of crypto-related stocks that Keith wants to take a look at. And that is, we're looking at RGTI. And that's Rigetti. You know what? Rigetti's not going to have we're not going to have the details on Rigetti, but we have it on MAGA. We have it on Mara. And Mara shows right now bearishness in it. And again, remember, this is seasonal bearishness. All right. Now, this seasonal bearishness goes out to around the end of April. And so, when you look at this, you can see this green does not mean that the stock's going up. This green means if you would have shorted the stock, would it have worked or would it have not worked? 2 of the last 10 years, Mara has gone up between now and a month over the next 30 days. But 8 of the last 10 years, Mara has actually gone down or has gone down in that time frame. But I could say this also. The amount that's going down over time has gotten to be less and less. Last year, it only went down about 4.28%, right? Year before that, quite a bit more. But we're seeing that trend start to drop a little bit. So what does Mara look like going forward? Well, you know what? We could maybe be able to get a look at that too. Let's see what happens as we go out into April. I don't have a pattern, which means there's no bearishness seasonal wise, but there's no bullishness seasonally on that as well. All right. And I got, AIRI. Let's try that. I still don't know. Again, I don't know every stock that we constantly look at because I let the computer do all that work. AIRI. Nope, I don't have it. I do not have it. But at the end of the day, guys, when I'm looking at these things, I start with a monthly view. And then from there, I drop down to the daily. All right. And then from there, I'm then looking at the individual stocks. I'm looking at those individual stocks to give me those best buys and those best sells. I'm going to take one more and then we're going to go ahead and move on. So the last one I'm going to take is from Santino, who wants to look at CCL. That's Carnival Cruise Lines. Wife and I are discussing taking a cruise. Probably won't be doing Carnival. Just a little bit out of my age group. But CCL, so here's Carnival Corporation. And as you can see in March, there was a lot of bearishness coming into March. Nothing we see coming into the end of March. How about April? Let's just jump out there to April. April showers bring bullish opportunity for Carnival. And so the earliest one I see is at April 2nd. You take a look at that and you see this goes all the way, it goes out to about Memorial Day. 8 of the last 10 years, boy, that 2022 was a rough one. But you got to remember, 2022 was a rough one for going into spring for a lot of stocks because that was a bearish year, right? We saw double-digit drawdown on ETFs, not just stocks. But in the last 3 years, you've seen some rebound. You've seen some rebounding in Carnival. And again, last year had a 20% move. So when I look at that 20% move, well, what happened during that time frame? Well, here's what happened. You had a stock that around the beginning of April was trading around 18, dropped a little bit, but look what ended up happening by the time we got into May. Coming into Memorial Day, had a good bit of liftoff. Right, so that's CCL. So again, what I do is I look at seasonality. All right, I'm looking at millions of data points, opens, highs, lows, closes on hundreds of stocks, not thousands, hundreds of stocks, because we take those stocks that are out there. I mean, I'm looking at maybe the top 1 or 2% of all stocks that are listed, maybe the top 10% of optional stocks that are listed. That's what we do when we're putting all this together to find these opportunities. And if you want my best opportunities and you're brand new to us, or if you're brand new to us, then check out the QR code above me, because this gives you the ability to get into an entry level. I call it an entry level program that we do. It's called Stock Cycles Trader. And Stock Cycle Trader, what we do is we actually go through and we do exactly what I do here, but we give you all those stocks and those ETFs that are really kind of in those windows, those 90% or greater windows. You get a lot of education with that as well. You get those start dates, you get those end dates, and you get it all for less than $1 a week. All right, with that QR code at the top. So if you're brand new to us and you want to check out seasonal trading, if you're done with the meme trading, if you're done with the day trading, all right, if you're done with the I think it's going up style of trading, then I would suggest looking at Stock Cycles Trader. It's a great way to understand how it is that me and a lot of folks that are on our team use pattern trading. So check it out. Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into 3 simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. All right, so I want to talk about constructing a straddle, and this is going to be part 1 of a 3-part series. Today, what I want to discuss with you is the basics of a straddle, and then we'll talk about one of the ways you can use as an entry feature for straddles, and those are either technical traders you're really going to like this. So let's talk about the basics, and let's talk about what this looks like when you put it together on a risk graph. So first of all, straddles are a delta neutral strategy. That means I'm neither bullish nor bearish. I'm a little bit of both, All right. And so we use straddles to understand how to make money without forecasting market direction. The other thing we're doing is we're offsetting what's called positive and negative deltas. So those of you that are option traders that understand, may understand a little bit about Greeks, then you understand that there are positive deltas with certain option strategies. There are negative deltas with certain option strategies. And delta neutral means we're putting this all together. All right. We're putting this all together to create a delta neutral strategy. It involves buying for every call option you buy. And this is an at the money call. You're also going to buy an at the money put. Okay. The deltas will offset themselves when you use both. We're also going to be looking at a straddle has to have the same strike price and the same expiration month. That's what gives the straddle its nature. All right. So for part of this, we're looking at the call option part. Okay. Now, long calls on their own are bullish. You buy a call option. That means you have the right to buy a stock and you have that right for X amount of time. If you're looking at the call option on its own, it has limited risk. It has what we call unlimited potential, meaning we don't know what the upside, there's an open upside there. Right. And you take a look at, for instance, what's happened with the markets here today with this big jump in the markets. It does kind of lend its way toward, well, where's that individual stock likely to go if you're buying a call? You have unlimited upside until you take that trade off or exit it. The put's completely the opposite. It's a bearish opportunity. You have the right to sell a stock at a predetermined price for a predetermined amount of time. That has unlimited potential to the downside until you hit zero. And it does also come with limited risk. A straddle's risk graph is when you put the two together. You buy the call and you buy the put. And by doing that, you've created this bi-directional, this particular trade that works in both directions. You might be, if you're looking at this for the very first time, you might be seeing, Tom, this is it. This is the only thing I need to know. I didn't know I couldn't do this. I didn't know that I could put a trade on regardless of market direction and make money. Well, it comes with a catch, right? So you need to understand that the part that is risk, there are three types of straddle risk here. Number one, there's time decay or theta risk. What that means is that if the stock, you're buying a call and you're buying a put, that means you're paying twice as much money as you would to buy one or the other. That means you also have twice as much risk on the trade. That's what you're paying for when you want to trade non-directionally. You're double paying. And because you're double paying, you have time decay, this is the greatest time decay trade that's out there. Buying an at the money call and an at the money put, because you've got time decay on both sides. The options can and will drop in value. They'll drop their time. Now, the other thing is vega risk, and that's when you buy options that are overpriced. And so, when I'm looking at like the Qs and I'm looking at the SPY right now in the markets, I believe they're overpriced. So that's vega risk. And then you've got delta risk. And delta risk is where the stock just simply doesn't get up and move anywhere. In order for a straddle to make money, a couple things have to happen. You have to either buy it cheap. You got to be buying it as it's going, as the time premiums increase and the vega risk is going up, because somebody on the other side and the collective option traders believe that the options, that straddle is undervalued. Or the other way you make money is the stock rockets out, all right, farther than the cost of the straddle. So how do they get profitable then? Well, exactly that. The price goes up where the calls make more money than the puts lose. The price could go down where the puts make more money than the calls lose. Or, like I said before, option prices get more expensive overall. That means the implied volatility increases. Both the puts and the calls gain value, even if the stock price doesn't move. Now, the best way that happens is when we come upon earnings season, right? But we're not going to talk about that today because very few stocks have earnings. The heavy hitters all happen next month. So let's talk about the first two. The price goes up or the price goes down. Price goes up more than the straddle's worth, or the price goes down more than the straddle's worth, and how we can find something like that. So here are three chart patterns All right, this is patterns and profits. Here are 3 chart patterns that work with a straddle. Right? No, they don't work 100% of the time. Nothing does. But these are good repeatable patterns that you can use. So the first one I find is the most popular among traders that like to buy calls and puts together as straddles when they have no clue where that stock or that asset in question is likely to go. It's called a symmetric triangle. That's where you have lower highs. All right, the highs get lower and the lows get higher. Now, you also find ascending triangles, and that's when you have same highs. That means you're hitting resistance, but support is climbing. And then you have descending triangles where that resistance is dropping, but support is holding steady. All 3 of these have points at them where the breakout of these is imminent. The question is the breakout going to lead to a big momentum trade or a fizzle? Right? So we look for them to become a big momentum trade. So putting these together, all right, here's an example of a stock right now that has a descending triangle. And it happens to be Tesla. So take a look at Tesla. Tesla has support right down here in the 380s. But Tesla over this year has dropped from 500 to the high of 450, to a high of 430, to a high of 425, to now we're down into the low 4s. So what's happening? We have resistance dropping. We have support holding steady. We have a triangle that's occurring. And so based on nothing else except the chart, let's construct a straddle with this trade. So I want to construct a straddle using the hub options data and the hub platform, and I want to use Tesla as an example. How do I create a straddle? Well, what I'm going to do is I'm going to pop in, and here's my chart, and I can see right away that as I'm looking at this, there's that descending triangle that, looking at an area where we might see an area on the chart that might make a move. Right? So from here, I'm going to go and I'm going to click on the options tab, which is down here at the bottom left-hand corner. I'm going to open that up. Now, most straddles I like to look at are, that 60-day roughly opportunity. So that's going to put us around mid-May. So here's my mid-May options. And I'm going to run, I don't need to run too many strikes because all I need to look at is where those at-the-money calls and puts are. Here's my at-the-money call options on the left, the 375, 380s. And here's my at-the-money puts on the right. Again, 375, 380. The easiest way to do this is right up here. You see this select strategy? We can select the straddle, and that's what I'm going to do. I'm going to click on straddle, and it's immediately going to create a straddle for me using the data that I've just collected. All right, so right here, I have the 380 call, all right, for May, mid-May, and the 380 put for mid-May. And if I come over here to the right-hand side, I can see exactly what this is constructing for me. It's saying, right now, the 380 call for May is mid-pricing just under 22, and the 380 put for May is mid-pricing just around 31.75. So putting these two together, this straddle is going to cost $5,368. Remember what I said. This is the most expensive strategy you're going to find in options. But when you got a stock, this is good for 100 shares of stock, both long or short, the right to buy, the right to sell. Because you have the right to buy and the right to sell, that's why it's costing you this much money. But you're putting this on a stock that's trading in the 380s. So here, I want to see what this looks like on a risk graph. So popping the risk graph up, it looks like this. So I'm going to move the graph. I'm going to move this up a bit, and there's your straddle to the right. The straddle shows me that it shows me a couple things. It shows me where my break-evens are. All right. Here's my break-evens, the dotted lines. All right. These dotted lines show me where my break-evens are on one side or the other based on how much this is going to cost me. Right, take that $5,368. You're going to add that to that $53.68. You're going to add that to the call, the straddle, and you're going to subtract it from the straddle, and it's going to give you those break evens at expiration. It also shows me what has to happen with this stock in order to see profitability. Right. And when I'm looking at it right now, it shows me this. Shows me that, if Tesla were to break out and quickly move back up into the mid fours, it's going to show me profits over here of, something considerable. Or if we drop down to new lows, we drop down into 300, then you can expect to see something that's going to be close to a double. So up here in the mid to high fours, profitable. Below, in the threes, profitable. Or something could happen today, jumped up 25 points or jumped down 25 points, and the calls might move higher than the puts lose, or the puts might move higher in price than the calls lose. But that's the basis of putting a straddle together. All right. Any questions, folks, that you have on straddles? Happy to discuss it. Now, this is a 3-part series. So what I plan on doing is over the next few weeks, I want to show you a couple other ways that you can get into straddles. Today, I wanted to talk about just about price point. Looking for those price points, like those triangles. Another one, if you haven't noticed it, I have Bollinger Bands on here. Now, I've said this before. I'll say it again. I'm not a fan of squiggly lines. Squiggly lines don't help me in terms of whether a stock's going to go higher or lower, but squiggly lines, when I put standard deviation bands, that's what Bollinger Bands basically are, is I look at the range of the stock and I look at the squeeze of those bands. I like to look at that squeeze and I like to get an idea. Let me turn some things off here. I'll take implied volatility off and we'll just be looking at the chart itself. See the bands, how wide they get over here? It just shows me we've got breakout. And when the bands get consolidated, it tells me price is consolidation and there could be an impending breakout happening. And so, we look for that squeeze to happen as well. That's a way of measuring volatility. It's a way of measuring what we call statistical volatility. All right. So that's not a squiggly line in the sense that I think the stock's going to go higher or lower. These particular lines give me an idea if a breakout is pending. It's another way of looking for consolidating markets. All right. So with that, I'm going to call it a day. Thank you all for joining me for another edition of Patterns and Profits Live. I appreciate having you guys with me here. What we'll also do in the coming weeks is I'll talk about alternatives, all right, for you, Becker, and others in creating a straddle that can actually lower the cost and lower the risk and also lower the break-evens. So thanks again for joining me, guys. Have a great rest of your day. We'll see you again on another one. Bye now.